Hello fellow investors. I will be dedicating the next videos to restaurant stocks, but I don't think I'd be covering all 50 of them. So if you have specific restaurant stocks you want me to review, just hit the comment section below. First restaurant stock I'll be screening is MCD, McDonald's Corporation. MCD is actually one of my forever stocks. These are stocks to accumulate and hodl for years. To tell you honestly, I just don't see a world without McDonald's anymore. Anyway, let's look at what prices we should buy the stock through our 5 valuation metrics. MCD is currently trading at $245.04 with market cap of $181.22 billion and PE ratio of 25.89. They give out an annual dividend of $5.52 per share, a yield of 2.25% of the current price. It's almost 10% of the highs at these prices. First metric, we want an EPS multiple lower than 3. It's 2.73. When I'm screening multiple stocks, I use this metric. Normally, if it's above 3, I'd pass, but when I'm screening individually, I try to be more considerate. This metric begs to understand whether the PE is too high or the EPS is too low. That's why I added the table here. We can see here the EPS is growing nice and steady. OSN is decreasing. OSN is number of shares. In the span of 5 years, McDonald's bought back only 54 million shares. What does that tell us? Maybe it's overvalued, that they don't want to buy back shares so much. Maybe they don't have much free cash flow left to buy back shares because they pay hefty dividends, $5.52 per share. Let's check on that later. Second metric, we want to pay $1 or less for 1% of the money they're making, meaning we want to pay 1 PE or less for 1% of their margins. This is based on the lowest net income and free cash flow margins of the current year or previous year, the trailing 12 months, and the 5 and 10 years average margins. This for highlighted values here. Now I didn't use the 10-year average margins here, these two, because if we look back at their financials, you can see that their margins then were kind of lower compared to now at high 20s. I'd like to think that MCD's margins are now better and here to stay, so I used 23.51 instead here to divide the current PE of 25.89, and we get a premium of 1.1. This means we're paying this much multiple if we buy MCD at these prices. If you look at their revenue growth, it's kind of all over the place. This might mean that McDonald's revenues may have capped. For MCD stock, I'd use a 40% margin of safety. So I could be a buyer of McDonald's at PE at 18, 20, and 22. Third metric is price to free cash flow. I want this below 20. If it's above 20, I'm not buying the stock based on this particular metric. It's 25.6, a little higher than my threshold. Ultimately, we want to pay a lower PE than their price to free cash flow. Fourth metric is designed for stocks that pays dividends. I want a payout ratio below 60. It's 58.29. So if you're buying MCD for dividends, I think it's safe. This metric basically discounts the dividends of the free cash flow. I do this because they can't really use the same money they pay out to investors to buy back shares. Buying back shares is very important because not only because it brings the price up, but it increases your ownership. The problem with stocks with very high payout ratio, they're left with very little free cash flow to use to buy back shares, pay debt, and to continue their operations. This metric shouldn't matter in the long run, but it gives you an idea of their future prospects about share buyback and dividend increment, and kind of explain why the chart behaves like that. MCD is not like a growth stock that could give you a lot of gains. It's actually a slow and steady kind of stock. With their revenues almost at cap, the only way to increase investors' value is to buy back shares. And they can't do that if they pay most of what they're earning as dividends. I guess that explains the only 54 million shares they bought back in 5 years. Fifth and last metric is historical PEs. We want to know our discount compared to when the markets have valued the stock before. I use the lowest average historical PE to divide the current PE. The metric suggests that MCD is trading at a slightly higher PE right now. Here are some metrics and ratios I look out for. PB ratio is 6.47, a little higher than my threshold of 5. Although compared to most owned stocks, MCD is still cheap, PB ratio wise. This is market cap divided by the total equity. Current ratio, above 1, good. This means their current assets are higher than their current liabilities, at least for this quarter. Their debt levels are actually high, so you might want to look more on that and assess your tolerance regarding long-term debt. This is the summary of valuation for MCD. These are the multiples you're agreeing to pay if you're buying MCD at these prices. I don't think it's a growth multiple, but I think it's a moat multiple. I don't own the stock. Based on their revenue growth, I don't think you should pay premium for the stock. I wouldn't rate it a sell only because of the nature of the business. So I'd rather rate it at hold. Fair value is around $220. Intrinsic value is $53.85. This is from Guru Focus. Here are my entry PEs and prices for the stock. I have a high price of $200. Actually, guys, for stocks like this, I'm okay buying at fair values. It's like a PG stock, an Apple stock. It's almost rare to buy these stocks at fair values because there are deep buyers for the stock. If we look at charts, it actually dipped at 220 in March. If you had bought it then, you're still in the money. And I think you're in it for the long run. 220 is fair value. Again, I don't promote buying at fair values because you want your risks priced in. $200, I'd buy hard. This is my high entry price. And if you care about your dividends like me, 3% yield is at $184. That's too far from the current price. I don't think it will drop that low. I could only hope it would drop that low. So yeah, these are the levels I'm watching for MCD. $220, $200, and $185, more or less. I have this trend line as well. Look if the stock bounces off this trend line or it would break to the downside.